Looking snazzy, brother.
Thank you. Hey, I apologize to everybody for the delay. I'm actually we're doing interviews for local and state candidates for the local RPAC committee. So Kelly was going to be there, but apparently she's got an issue with her dog and had to run them to the vet. So everybody say a prayer for her dog and hope it's not anything too major. So again, I apologize for the delay, but I do have the presentation. I only have about 15 or 20 minutes, and then I got to get back into the interviews. I actually stepped out of an interview so I could come be with you all. So let's go ahead and dive into this thing. Let me make sure that I got everybody. Yep. Okay. I got everybody in. I'm also working off of my phone Wi-Fi here, so hopefully we don't get too many interruptions, and everybody can hear me okay. So let me rearrange my screen. And there's a couple of key things that I wanted to touch base on. So first and foremost, wait, hold on. That is not what I was trying to do. Slideshow. Here we go. Okay, can everybody see the presentation? Rebecca, raise your hand if you can see, so I can see. Okay,
Yes.
perfect. All right, awesome. All right, so wanted to touch base. I'm only going to talk about our two main markets today. I'm going to fill in our other markets as we go. We're transitioning between Kelly taking over as broker and having MLS access and things like that. But I was able to pull Owensboro and E-Town numbers, and looking through July 19th, it looks like we've had 99 listings sold. I actually really like this number. We're on pace for July to be better than June. And as you all know, you've heard me talk about it, we took a slight step back in the month of June, looking like we're going to finish July just slightly ahead, especially considering we had that first week of the holiday and there weren't a lot of closings. I mean, you can see on there was 20 closings. What's really interesting is I'm seeing a trend in the average days on market starting to drop. So I started diving into that and trying to understand what's going on there. And as you can see, our active list well. So in May, we were at 286. We were at 280 in June. Oops, I went to Elizabethtown. And now currently sitting at 273. So as the inventory constraints, homes will continue to sell faster. So we're starting to see a little bit more buyer activity. I think we've seen that in both markets as I switch over to E-Town. We're so tied to interest rates right now. If interest rates take a slight dip down, it seems like we all get a little bit busier. If they take a slight tick up, then we all tend to kind of hit a slowdown. And we're in this, in my opinion, at least, a strange period where I think a lot of people are expecting an interest rate cut. And as we get through this and work through this, you'll see that it's definitely on the horizon as far as interest rate cuts. So I think a lot of people are kind of just sitting back and saying, hey, you know what? I'm going to sit back, wait, see what happens, both with the elections coming up and then also with these interest rates, and then maybe look into diving in. So again, it's all about finding the motivated. You know, I've heard me talk about that endlessly. So in Elizabethtown, kind of seeing the same thing now in regards to days on market. I know we had a little uptick. We're at 96 for last week, but as you can see, we were underneath 100 days, which is good. I like to see that number start to drop because we've been over 100 for a little while. The sales are still low in E-Town. Month over month, I mean, we're projecting to finish somewhere around 405 sales, maybe 425 sales. And we had 544 in the month of June. So, at the same time, we're starting to see inventory increase there, going from 512 active listings available in the month of May all the way up to 585 were available as of last Friday. So the good news is your clients, your buyers in particular, are having more options to choose from. From an opposite side of that, your sellers are probably having to get more aggressive in pricings and or concessions just due to the competitive nature of the number of listings that are available. Diving into price points behind this, as you all know, entry level homes, and at this point, I would call anything under 175 kind of an entry level home, meaning like first time home buyer affordability standpoint. Those things are gone. It hits the market, it flies. If you get up to from 175 to call it about 350, that's where you're kind of seeing the average days on market that I'm showing on these graphs. You get up above 350, then expect everything to take longer, unless it's just such an aggressive price, or it's a home that has really unique features. Maybe it has a shop on it, maybe it has acreage, maybe it has a pool and somebody wants a pool. So we're having to play matchmaker at a higher level than we've ever played before in terms of buyers making sure that they get exactly what they want, because when they're paying a premium price for a home, combined it with today's interest rates, then they're going to get exactly what they want, or they're most likely not going to make a move. So where I'm going with that is making sure that you understand your client's wants and needs, and from a buyer standpoint, and then from a seller standpoint, understanding the motivation and timelines of when they need to move. Because if somebody maybe doesn't need to move for 6 months, they might be slightly less motivated to get aggressive in pricing or make repairs and things along those lines. But as that timeline condensed down, they would get more motivated and be able to move more or do the things that they need to do. So don't forget to revisit your timelines with both your buyers and sellers, because motivation can change, especially when you're looking at a multiple month process. Looking at mortgage rates have held fairly steady. This is last week's rate. You can see we're at a 6.8 according to the Mortgage News Daily. FHA is 6.26, VA 6.29. Just ever so slightly up. And really this just happened yesterday more than anything. 6.89, 6.33, and 6.35 respectively. So still lower than where we have been in quite some months, but not quite where the consumers that are unmotivated are willing to make a move. And there's a numerous factors that obviously pour into that. One thing that I'm starting to see, and I just want to make everybody aware of it, is I'm starting to see where lenders are advertising significantly lower rates than what we're seeing. So for example, there's a local lender here in my town in Owensboro that I just saw a conventional rate at 6.25. And if you read the fine, there's a little asterisk next to it. If you read the fine print, that includes buying a point down. So meaning you're going to pay some upfront money to get a lower interest rate. I just want to bring awareness to that for you all, because when we quote rates, because people are always going to ask, hey, what's the current rate for us? Just make sure if you're pulling from a local lender, check into that and make sure that it's not points driven. If it is points driven, call the lender and understand what's going on behind it. Some lenders may be offering an automatic buy down, meaning they're contributing to buying down points right now. But you definitely want to know that before sending that information out, because the last thing we want to do is quote somebody at a really low rate, but that's going to cost them $10,000 to get there, and they don't have that money. So what else is going on in terms of the mortgage rates? It's the fourth week of the month, or at least fourth Monday of the month. So I'm going to do a quick little economic update. Couple of things that are really driving the rates, and then we'll talk about where we see the rates going at towards the end of this. But CPI, everybody's always heard of that, heard me talk about a consumer price index. I pulled all the way back to, I believe this starts in 1960. And you can see where the consumer price index is. And what I really want you to see is, especially here, this is the pandemic. This is where we had that stark rise in inflation. What I want you to see, we're coming down and matching the pace of it going up. This is really good news. So we want to continue to see this downward trend, and we don't want to see it level out. So just so you know, kind of what I'm watching is, are we matching going down as fast as we went up? If we maintain that, and you can see in previous history, we typically do. So we typically, if it goes up, it's going to come down at the same rate or even faster. So we want to just make sure that that continues as well. In terms of GDP, of course, that's gross domestic product. Our economy is doing better than it really has done at any point. I mean, I went back, this is to 2015. Our economy is actually growing at a rate that we haven't seen since, honestly, the 90s at the earliest. So this is one of the factors that's keeping the rates up high. As long as the economy's doing good and inflation is going down, as well as we'll look at some unemployment information also here in a second, then this is kind of the leveling factor. If it weren't for GDP, then honestly, we probably would have already had rate cuts. But for whatever reason, our economy is still doing very well for numerous reasons, I should say, not whatever reason. In terms of unemployment, this has been another sticky factor. Part of the reason that we haven't had rate cuts going back into 2023 is really this has been underneath 4%. And one of the big keys for the Fed to look at is, are people hiring or are people laying off? And while we don't ever want to see anybody lose a job, obviously, this is good news for us from a mortgage and a business standpoint, because you can see we crossed over 4% for the first time in June, which means that the hiring has slowed down. Business owners, whether it's small business or large corporations, are starting to feel the squeeze of the economy. I think we can all agree we felt it over the last year or two. But that is one thing that we want to continue to monitor. And if it trends in this direction, then all signs are pointing to multiple rate cuts, which obviously would lead to business growth for us as realtors. Looking at potential Fed rate cuts, Jerome Powell did a talk with, I can't remember, it was a Senate, I don't remember if it was a Senate committee or if it was the House.
No,
basically has come out and has said that he fully expects a rate cut in September should everything maintain pace between now and then. Now, there is a Fed meeting on July 31st, if I'm not mistaken, on that date. We don't expect a rate cut at that point. I mean, I would gladly welcome one, but I don't see one. The good news is the next meeting, which is September, 95% chance is the current chance that we have a rate cut, which would most likely be a quarter of a point reduction. Because remember, we don't need inflation to go all the way down to 2. We actually want to start the reduction before 2 so that we have that what is it that they call the smooth landing, so to speak, off of those things. So good news, we expect a rate cut in September. This is probably why you're having some buyer reluctance right now. I mean, this is all, if they're paying attention to this at all, they know that it's coming, and that's why they're probably not as motivated to move right now. Looking at more long-term rate cuts or predictions, I guess I should say, and keep in mind the further out you get, the less accurate this information is. But what I really wanted to show you is, we're sitting, looking at the actual Fed rate, not mortgage rate, but we're sitting right at, 6s right now. 5.25 to 5.5 is the prime lending rate. And we fully expect that to continue to go down. As a matter of fact, I'm just trying to move my screen around so I can see the bottom. There we go. As a matter of fact, we expect that to drop into the 4s throughout, or lower 4s by 2025, and potentially getting even into the 3% by 2026. So this is good news. That means mortgage rates are usually going to be 1.5 points higher than that. So looking at somewhere around 6% interest rates for 2025, maybe even get down to 5.5, with potential of 4% interest rates going further than that. So looking out at the 30-year mortgage predictions, which is your orange line here, as you can see, 2024 we're call it 6 3/4. By 2025, expect to be underneath 6. 2026 to eventually break underneath 5, and then kind of 27, 28 to be at our final landing point, which we predict, at least based off the information we have right now, somewhere around 4.5%. But what I want you to know is we have 2 or 3 years before we get there. So if any of your consumers are talking about, hey, we're going to have drastic rate cuts, I'm waiting on interest rates, so they're going to go down 1% over the next 6 months, and then I'm going to buy. This is the type of information that I want you to use in order to be able to get them, to educate them to what's going on so that they can make a really great decision. So that's your market update for now. I see Kelly is on. Kelly, I hope your dog is okay. Oh, did we lose her? She was on. Where'd she go? We might have lost her. Hold on. Or do I just not see everybody? 1 second here. Oh, there she is. So, Kelly, I told everybody that you had a little puppy emergency. I hope your dog's okay.
Well, no, the dog is here at the office because I was so fed up. I had a dog poop while I was there on the floor, another dog poop while I was there, and I sat there for an hour. I finally went up to the lady. I said, I was supposed to be dropping my dog off, and I said, I'll come back tomorrow because I can't, Kentuckiana needs to get it together.
Let me
Awesome. Well, I went over.
let me guess. Moose.
No, Jax. Jax is here because I couldn't get him in.
Cool. All right, cool.
That's
Good. I'm
funny.
glad Moose didn't give me a.
Look, there he's Jax is in there. Look, he's in the office. He's walking around. So
You're
Oh,
telling
nice.
me all this crazy stuff on the day I'm getting a new puppy. Thanks, Kelly.
sorry.
Well, I'll tell you what, y'all, I'm going to jump back into my RPAC interviews. I wanted to just go over those market stats. I mostly wanted to update you with what's going on in the economy and why rates are being as sticky as they are. The good news is all signs are pointing to it getting better. The only question is how long is it going to take? So over the course of the next 2 years, we expect rates to get into the fives, but we got to go out and find the motivated before then. Let's see, Melody, we're not in a seller's market, but not really a buyer's market in between. We're still a seller's market up until you get to the really upper end price points. We're still a seller's market just because of the lack of inventory. I think what we're facing is buyers just being more picky, but they still don't have a lot to choose from. So in terms of who has the upper hand in the negotiations, it's still sellers without a doubt due to the lack of inventory. We just have buyers have challenges in affordability and things along those lines. So we are trending towards a neutral market. We are roughly 3 months worth of supply in each market, a little less than 3 months. 6 months is a balanced market. So we still have a ways to go. And honestly, I think we will have, and this is good news for us, I think we're going to have supply issues for the next probably 5 years at a minimum, maybe even 10 years. So the good news is that will prevent any type of housing crashes, anything along those lines. We don't have to worry about bubbles like what we dealt with in 2008, 2009. The challenge is going to be finding the motivated buyers that have a reason to move, because people aren't moving just for the sake of moving right now. Good question. All right. And with that, I'm going to turn it over to Kelly. I'll let you talk to him a little bit, and then I'm going to jump back and figure out if we got any good candidates on the local and state levels.
All right,
See ya.
guys. So